Good afternoon and welcome everyone to today's US markets update and our second quarter earnings review presentations. Great to see so many on today's webcast. My name is Kelly May, Associate Portfolio Manager, and with me today are Fortrend CEO Joe Forster, along with our portfolio managers Chris Wallerman, Stephen Lyle, and Andrew Corcoran. We welcome question and answers throughout the presentation. Please feel free to click on the question and answer tab at the bottom of your screen to ask a question. We will do our best to answer it in a timely manner and as best as we can. With that, I'll now turn the presentation over to Joe.
Thanks, Kelly. Welcome. We're seeing the markets continue to rise as a result of quantitative easing. The U.S. GDP sank 9.5% in the quarter, but we saw earnings estimates for going forward actually up and the market up. So there's a dislocation, and the question becomes, how do you reconcile this 5.5% increase in the S&P 500, a firming of the earnings estimates for 2011, and now a forward-looking price-earnings ratio of 20 versus a decline in economic activity, which of course is historical. The 10-year Treasury is now yielding. I just want to say, Kelly, can you get rid of this picture up there? I want to see the screen on this.
I can put it higher.
Yeah, thank you. Okay. So Jerome Powell. There's fine. Yeah, but just drag it down to the bottom right. Yeah, there you go. Way down, way down. There you go. Okay, so Jerome Powell has done the in triplicate. They're not thinking of raising rates. They're accommodative for the long term. They are here to stay to support the economy with these extremely low interest rates. Of course, Google has done a bond issue at about those rates, which is amazing that money is basically free. So why not borrow to buy back equities? As I say, the GDP fell 9.5% in 2Q, and it's hard to find in these earnings announcements, particularly with the leaders in the market, those companies with falling revenue. They are focused in, of course, travel and airlines, hotels, and resorts and leisure and sporting events. But when you look at the leadership in the S&P 500, companies like Kraft and Mondelez or Procter & Gamble or the FANG stocks, we're seeing a lot of strength in the biggest companies, with Disney last night reporting excellent earnings. In the entertainment sector, the three big leaders there, Comcast, AT&T, Verizon, and Disney, four big leaders with about $200 billion market caps each, are all doing very well. So, as I said, the weakness is in travel. Business and customers are cutting expenses, and this is being partially offset by assistance to households and businesses provided by the government. The amount of money that the U.S. government is accumulating in terms of debt is as astronomical, but the cost of servicing it has come down and is next to nothing. So it's creating an optical illusion where debt is not relevant, and that is a concern if we did have inflation. The issue right now, though, is we will not have inflation. In fact, we've got a much bigger risk in the world today of deflation. We, for many years, had low interest rates as the U.S. government was trying to stimulate some increases in prices, and of course that didn't happen because of the improvements in productivity. The internet allowing for phones, allowing for collective learning, and the general falling of prices as productivity was enhanced so dramatically has resulted in it being very difficult to get any price inflation traction going. And of course, if you have prices going up, people want to buy to keep buying before prices go up. And if you have the prices going down, people will just stop buying and delay for the future. This quarterly GDP number, we saw prices actually falling. And the biggest concern here should be deflation and people just stopping doing everything. So we think that it's surprising that the deflationary risk profile of the market has not come to be. We saw that about 2 years ago when the economy slowed some and there was a risk of deflation, but it knocked the market, but it didn't eventuate.